All right, so this week is starting with stocks ending exactly where they left off last week. All three major indices ending in the red today. So how long is this little stock slump going to last? Joining us now, our financial panel, Sean Hyman, trader and editor of Money News Ultimate Wealth Report, David Scranton, CEO and founder of Advisors Academy, and Jeff Taylor, here in studio, managing partner at Digital Risk. All right, Sean, I want to start with you first. Everyone's talking about these momentum stocks falling off a cliff, Tesla, Netflix, Amazon. Why do I care, right? I mean, weren't they up on air anyway?
They were, and they were way overvalued, but the reason why you should care is because as they start to tumble, they're like the domino that tips over a lot of others, and so a lot of other stocks start tumbling down with it. A lot of margin calls start happening, so it starts a whole lot of commotion in the markets, and so it starts a bad downward move in the stock market overall.
But David, as the CEO of the Advisors Academy, are you advising people to even buy these stocks at all?
Well, at this point, you have to be really careful. Arguably, a good part of the reason the stock market is as high as it is, especially the momentum stocks, is because of all the quantitative easing. And I think investors now are getting nervous. They're worried about what happens when QE ends, what happens when the rug gets pulled out from underneath the market. Could that cause a drop? And investors, especially large investors, have one finger on the trigger right now when it comes to the stock market. So you certainly have to be cautious.
And that's the thing, Jeff. You know, Sean makes an interesting point. We kind of just follow the herd around here. Like, you often wonder who makes the first decision, and you want to be that guy because then everyone does what you do thereafter. Yeah.
So, you know, counterintuitively, so momentum stocks, the home builders have gotten really kind of beat up over the last 6 months. But you look at some of the data right now, the actual first-time home starts are at 600,000, where typically we need 1.2 million a year to keep up with population growth. Interest rates are at all-time lows. So I think, and after coming off this horrific winter that we've just had, I think you're going to see a really nice spike in growth over the next 6 to 9 months. So I'm actually going a little bit against the grain and calling for the home builders to really pick up momentum.
Just the home builders, though, not the other momentum players.
So the other momentum players have a lot of more macroeconomic issues that could play into them right now. Some are overbought, some people are getting nervous. But again, the home builder play is a nice little niche that I like. Companies specifically, Lennar, Toll Brothers.
Okay, so Sean, let's play off of that a little bit. If we're starting to see maybe some turnaround here, we're also starting to see people say, yeah, you know what, I'm done taking risk. I want a little bit more dividend action. I'm going back to the tried and true, right?
Yeah, absolutely. It's a safer way to play it. I mean, if you think about it, the stock market overall tends to return about 9 to 11% per year on average. Now, we just came out of an above average year, but you'll also see some below average years. And sometimes some dividend stocks can get you a third or a halfway there to your annual dividend to begin with. And that's a much more stable piece of the stock portfolio is the dividend income. So a lot of these baby boomers that are now starting to retire are wanting these dividends to supplement that income, because truth be told, a lot of them haven't saved as much as their parents did, and so they need additional income anyway. So that's a safer way to do it.
Yeah, David, what's old is new again, right? And you know, it's so interesting that we focus on fundamentals and then we get lost because some guy says we should go invest in momentum stocks, right? And then everyone comes back to the grain again, and here we are, back again to the tried and true. Should that be where people are focusing on?
Well, I think so, because a dividend is really the only thing you can count on for sure in a stock. It's the old bird in the hand. And I think the reason that these have been income dividend stocks have been so strong lately is simply because of, again, what happened with QE. The whole purpose of QE is to drive down the yields on long-term bonds, or at least part of the purpose, so that the yields on stocks look comparable and it pushes people up the risk curve. And at least that way there, if they do lose 10 or 20% on a pullback, at least if they're getting a nice dividend, it makes it a little bit easier to handle.
Sean, though, I want to jump back to you right now, though. You know, as Jeff mentioned earlier, let's be contrarian here. Tesla, Netflix, Amazon, all down. They're not going anywhere. Why wouldn't I buy them today?
Because, believe it or not, even as much as they've pulled back, they're still grossly overvalued. And, I mean, some of them, even Tesla, I mean, they haven't made money. They're just starting to make some money. So it's still an unproven company. It's a nice concept. It's a neat concept. But if you think about it, back in the early days of automotive, I mean, that was a neat concept. There was a ton of automotive companies that came out there, yet only a few still exist today. So, you know, just because you have a neat concept doesn't equal a great investment idea.
Fair enough. Although I think between my household alone, we support Netflix and Amazon. Jeff, let's talk about the IPO market, because a lot of it has to do with the president's jobs, the Jumpstart Our Business Startup Act, right? It made coming to market easier. Is that a good thing?
I think it's a good thing. I mean, look, right now, look at the IPO market. The good thing is I still think that the PE ratios and the valuations are still within a decent range. But again, back to the point of like we invest in stocks for wealth creation right now. And you look at interest rates still being historically low, a little bit, again, contrarian. If people are looking for that long-term value play, buying a house might be the first time, the best thing they could ever do at this low interest rate, lock that in and build equity over the years.
But if I am looking at my portfolio, David, are you going into this IPO market at all? You know, Renaissance Capital put a number out. 71% of all IPOs this year were filed confidentially. That is all thanks to President Obama's Jobs Act. Are you going to touch that stuff?
I think if investors today are getting into IPOs at this point, they need to be careful and maybe look at it more for the short term. The last time I could remember that there were as many IPOs coming out simultaneously was November of 2007. And of course, that was just the beginning right before we had that last stock market drop of 57% on the S&P 500. So, you know, we have this this anomaly, we call it, saying that typically when a lot of small investors get into the market, it's probably overcooked and ready for the next drop. Well, I believe there's also an investment banking anomaly that when the IPOs get up to this level, that it might be because they're trying to get through all these before the market pulls back.
Yeah, it's starting to feel a little deja vu all over again. Sean, David, Jeff, thank you so much, you guys.